Hey traders, Clifford here, back with another video on trading the charts. So in the last video, we spoke about the 1-2-3 top to 1-2-3 bottom formation, how it can benefit you in your trading. In today's video, we're going to take a look at one of my favorite chart patterns in the world. It's called the head and shoulders chart pattern, and I believe it to even be more powerful than the 1-2-3 top and the 1-2-3 bottom. So with that being said, let's rock and roll. Okay, now take a look here. Head and shoulders. So basically, this is another form of a reversal. And the difference is it's more significant in the way it's formed. So here's how it works. You know how the 1-2-3 top and the 1-2-3 bottom works now because I made a video about that. But the head and shoulders is a little different. It's partially a 1-2-3 top, but there's more involved. So here's what it looks like. You pull up a daily chart. I always use the daily charts. Again, you could find these on whatever time frame you want. If you want to look at a 4-hour, a 1-hour, a 5-minute, I mean, it's entirely up to you. But I find the daily to be the most significant moves. So here's how it works. What you're looking for is almost like the shape of a W. Now, in this chart we're looking at right here, I can see the head and shoulders. You may not be able to see it unless your eyes are trained, but that's what we're going to learn right now. So basically, you're looking for a W. And again, technical analysis is a little bit like art. So you always got to kind of think about it as it is subjective. What you see on the chart, another trader may also see on the chart, or there may be a different variation a little bit. But for the most part, he's going to see the same pattern that you see. 80% of the world's traders who are studying these charts, I believe that's normally the statistic on that. So here's how it works. You have what's called a left shoulder, which is it starts around right about here. Then you have what's called the head. Now the head is like the top of the market. Then you form what's called a right shoulder, and then you form what's called a neckline. So we're going to draw this out to illustrate it. So basically what's happening is this. The buyers come in, they push the price up, right? This is the euro, by the way, we're looking at, but it doesn't matter what market you're trading, crude oil, crypto, stocks, whatever your favorite market is, you could see these on the charts. So here is so the buyers push the price up, sellers come back in and push the price down. This is known as the left shoulder. Then what happens is the buyers completely try and smash the price higher and create a peak. The peak is known as the head. Sellers try to push the price back down and they are successful. And then the buyers get one more shot at it. This is kind of like you could say the last moment, the hope rally, right? They try and really push it up higher before the reversal takes place. This forms the right shoulder, and then the sellers finally take over and push it below where everything started. Now, the point where everything started is actually called the neckline. And again, technical analysis, a little bit like art, so keep that in mind as I explain this. The neckline is this area right here. It's kind of like a support level. If you remember my last video, we spoke about support and resistance. This is a support level, the neckline. So basically, you got a left shoulder, head is the peak, right shoulder, and then you got the neckline. So how do you trade it? Well, basically, if it's a head and shoulders top, this is a formation that signals a reversal in a bull market, changing over painful reversal to a bear market. So you want to short, but where do you short? Well, you sell after it breaks below the neckline, right here. So you go short. And then what you do, the way you get the profit target is you measure the distance from the top of the head. You can use this price tool this is TradingView. I use their price tools here. And you measure the distance from the top of the head to the bottom of the neckline. And again, I'm not being perfect here, but as you can see, this is about 300 ticks or 300 pips in the Forex. And then what you do is you project that target lower, which is about, well, what would we say, 300? So it's about maybe here. right? About maybe 300 right there. And then that's a successful trade right there. And look what happened. So you went short here on a break below the neckline. By the way, put your stop always above the right shoulder. I like to put it above the right shoulder. Some people like to put it above the head, but I think the right shoulder is a good place to put your stop. So look what happened. The sellers took control, which you entered short here. Then the buyer said, no, we're not going to let you get control of this market. And look, they tried to push it higher again, but then there was what? A rejection. See this candle right here? They pushed it up. Seller said, no way, we're taking control. They push it back down. Never got above the right shoulder. That is very important that you realize that it never got above the right shoulder. It did get above the right shoulder temporarily during the day, but by the end of the day, the sellers had already took control again and pushed it lower. So, I mean, technically speaking, if you put a stop right above the right shoulder, you might get stopped out. So you might want to go a little higher, maybe like halfway to the head is probably safer now that I think about it. If you're using options, of course, you don't even have to worry about this because you can never get stopped out with an option. All right, so you short here, and then you just hold it until it reaches the profit target. So here is a 300 pip move from the head to the neckline. You project it lower, and look what happened. It hit the target. You made money. But more importantly, right after it hit the profit target, the market completely changed direction. So that's how powerful this technical analysis stuff is. Right after, I'm not saying everyone on the charts was watching this formation and then decided to take profits at the same time, but it is very interesting how that happened. All right, one other thing, opposite head and shoulders. This is a head and shoulders top, but there's another one called the head and shoulders bottom. Basically, it's the opposite. This one's a little bit trickier, but once your eyes are trained, you'll be able to see this too. It's called an inverted head and shoulders because obviously it's not a top, it's a bottom. So the inverted head and shoulders pattern works the same way. This is a chart of basically the US dollar. I mean, we could look at cryptos, we could look at stocks, whatever, but I'm just looking for now at the US dollar. Do you see the bottom? I'll give you a minute. Okay, if you don't see it, watch how easy it is. And again, it does take time to get this. It took me years, but now I see it like clockwork on my charts. Every time they form, it's really amazing. So here's the left shoulder, right? Here's the peak. Now again, it's kind of like a peak, a selling peak. They pushed it all the way down. Here's your right. Here's your head. Left shoulder, head, right? And then we got the right shoulder, right? Um, Again, it's like art, so you got to kind of play around with your drawings here. And the neckline, where is it? Right there. Well, pretty much right. Actually, you want to kind of get at that support and resistance level there if you can. So there you go. Head and shoulders inverted reversal pattern, meaning that if we're in a bear market, now we see an inverted head and shoulders, what's going to happen? Well, we are in a painful sign of reversal going from a bear market into a bull market. And that's exactly what happened. Look, right after it broke above the right shoulder, again, sellers tried to push it below the right shoulder, but they couldn't. And then boom, you make it to the profit target. This pattern has about a 90% accuracy from what I've seen over the years. So when you see them, it's okay to get excited, but of course, there's always risk. And always understand that just because we see one of these really powerful, reliable 90% profit potential probabilities doesn't mean it's going to be successful, because 10 to 15% of the time we may lose money, right? So we want to be prepared for that. So always keep your risk management in place when you're trading, regardless of what you're trading, actually. Let's do one more. So here's one I've been looking at lately. This is the Australian dollar. I saw one on the cryptos. Did I see one on the cryptos the other day? No, it might have been the grains. I think it was one of the other markets I watched. Okay, well, we'll do this one, Australia. So here's the Australian dollar. And this is why I use the daily charts, because I only have to check it like once a day to see these patterns as they form. Every day represents one candle. But again, you could use any time frame you want and be successful at this. So what do you see? I'll give you a minute. All right, here it is. So we take, again, draw it in, left shoulder. That's the first rally. Head is the peak, right? And again, it's a little like art. It's not going to be perfect all the time. Sometimes I'll put my right shoulder here, or sometimes, I'll put it maybe here. I mean, it's not 100%, perfection when you draw these, but you want to try and be as accurate as you can. So now here you go. So look what happened. We got the head, left shoulder, head, right shoulder. But what do we do? When do we enter, right? Well, again, we got to wait for the break below the neckline. Do not short before you see the market close before the neckline. Got to wait like a cat sometimes. Like you see this forming. Oh, actually, the right shoulder is here. Now that it's a big head and shoulders. This one was kind of wider, so like you can see it's a little bit more wide than the other ones we had. But anyways, a pattern is a pattern. It doesn't matter. So wait for the neckline to break below, which is right here. Now you short. Why do you wait? Because you kind of want confirmation that the sellers have decided to really, all the banks and institutions and people who really push this market want to really push the price lower. So that's why you wait for a close below the neckline, which is once again right about here. You short here. Again, put a stop above the right shoulder up here, or maybe like we said, halfway to the head. That way, we don't get stopped out. And then you measure the distance once again from the top of the head to the bottom of the neck, which is here. Kind of measure that down, 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 down. This is going to be a large move if it completes. And what do we get? We get about a 456 pips move, 456 ticks. Now this one's live actually. This formation has not completed yet, but look, we're already at about what? Maybe 262. So there you go. So if this one completes, what do we say? 456. So we want it to go here. 456. If the market gets that far, let's see what happens. I mean, this trade is still live. So let's see. I'll update next week or the week, or I'll be watching this trade to let you know if you guys want to know if this trade completed. Definitely keep an eye on the Australian dollar. And I believe we could make it down here if the dollar continues to strengthen. So, of course, fundamentals play a part too. But for the most part, even if you don't know about the fundamentals in the market and you're just watching the charts and you trade these head and shoulders, you can be very successful. So that's about it for this video. If you enjoyed the video, feel free to like, subscribe, put your comments below. And I look forward to seeing you guys in the next video. As always, thanks again for watching. Trade what you see, my friends. Trade well.